Good morning. It's Friday, the 21st of February, and this is Govindraj Ethiraj, headquartered in broadcasting and streaming, as always, from Mumbai, India's financial capital, which, if I might remind you, once again, is getting warmer. The top stories and themes. The large cap stocks are weak, with the mid cap and the small cap segments are moving up. The untold story. Foreign portfolio investors sold 120,000 crores worth of stock in 2024, but also bought 120,000 crores worth of initial public offers or IPOs. Gold prices hit a fresh high as banks struggle to move bullion bars around the world. The rupee is on a firmer footing this week. And why companies from Schneider Electric to ABB are reporting sharp rises in profits globally.
This is the Core Report with Govindraj Ethiraj.
The middle order moves up. So which team is playing well, the small caps or the large caps? Well, it's quite clear that for the last few days, the smaller cap stocks are doing better than the big cap stocks, and the large caps, which represent stability, are also facing the brunt of the foreign portfolio investors who are selling, as we've been seeing in recent months into this year, who of course own a lot of large cap stocks to start with. So the middle order is holding out while the top order is on a weak wicket, so to speak. Now, we will bring in several views today from a cross-section of markets, including initial public offer markets or IPO markets, gold, and of course currency, which will hopefully give you sufficient material to ponder over the weekend on which direction the markets in general and specific will be headed. Meanwhile, the Sensex fell about 203 points to close at 75,735 after having swung a little bit, but not as wildly as other days. NSE Nifty 50 was down about 19 points to close at 22,913. The middle and bottom order, like we pointed out, continues to do well. The Nifty small cap index was up about 1.5%, while the Nifty mid cap index was higher by about 1.3%. So why are foreign portfolio investors selling in India, at least in the secondary markets? Now, there are a lot of macro reasons, which we've heard from corporate performance to rupee and so on. The other angle that's emerging now with sharper focus is China. Remember, we did mention just earlier in the week that some $700 billion has rotated out of India back to China. Harold van der Linde, head of equity strategy for Asia Pacific at HSBC, told Business Standard newspaper that apart from an earnings slowdown and rising US bond yields, the outperformance of Chinese markets is a key reason for the sell-off. As to why the sentiment shift out of India back to China, he says, well, everyone wanted to be in China between 2018 and 21, and then sentiment soured. The problem, he says, is that in India, the main attraction was high or very high earnings growth, which is now under question. And here's the important point. He says that you always sell the market that's easiest to sell, and India is one of them. If there is ease of exit and entry, then that works to your advantage and to your disadvantage as well. So it's a combination of earnings concerns, rising bond yields, and the attractiveness of China, and of course, the ease of selling. The immediate future is a little tough to call, he says, and it also depends on whether investors soar on China, which will help India. But as long as China outperforms as it is right now, particularly after that launch of DeepSeek, then things look a little tougher for flows into India. What the market does want to see is clear earnings growth and the hope, of course, that China slows down. On the earnings side, of course, things are a little away. Der Linde told Business Standard that the market is uncertain whether India's earnings growth will be 15 or 10%. It all comes back to valuations, of course, but the perception right now is that Chinese equities are very cheap and the growth there is also looking stronger. So, HSBC is neutral on India and South Korea, overweight on China, Indonesia and Hong Kong, and underweight on Taiwan and Japan. So that gives you an Asia-wide view. Relatively stronger India themes are tech, which benefits from a weak currency, consumer discretionary over staples, thanks to more attractive valuations, and automotive companies, something that we've been pointing out here as well, which are seeing good growth. And here's the reason, in overseas markets as opposed to a relatively weak local market. All of this is HSBC. They also like hospitals for, I guess, obvious reasons, and private banks. Elsewhere, Nomura also released a report which says that despite a 16% correction in the Nifty 50 in US dollar terms from its record high levels, it's still seeing muted returns in 2025. Nomura is essentially seeing the Nifty 50 reaching about 23,784 by December this year, which means an upside of just 3.7% for the rest of the year. Nomura says the price to earning valuation multiple for Nifty 50 has moved lower to 19 times 1 year forward earnings from the September 24 peak of 21.3 times. There are other bull and bear cases, but I will not get into them. A quick glance, meanwhile, at the energy market and oil in specific, and where things are not really moving right now. Oil prices were steady on Thursday after rising to a near 1 week high in the previous session, thanks to a build-up in US crude stockpiles, according to Reuters. Brent futures were up slightly at about $76.41 a barrel, even as US crude stocks rose by about 3.5 million barrels last week, market sources told Reuters. How foreign portfolio investors have been buying IPOs. So let's look at some supply and demand factors. Remember how the secondary market performs is also a function of flow of funds into the primary market, which have been substantial in the last year. First, the larger numbers. In the last calendar year, foreign institutional investors sold about 121,000 crores worth of stock. But, and here's the interesting thing, they bought almost an identical amount of stock in the IPO market or in initial public offers, according to Prime database. Here's the other interesting stat. Between IPOs and QIPs, or qualified institutional placements by institutional investors, we've seen huge money flows. So some 387,000 crores in the last 4 years went into IPOs. That's from everyone. And 250,000 crores additionally was invested by institutions in IPOs once again. So that's over 630,000 crores in 4 years going into IPOs. And maybe that's over $150,000 on an average per year. So all of this tells you the sheer amount of institutional activity in initial public offers. Now, going forward, there are two questions. First, how are things looking from a supply and demand point of view? And what could be the absorption capacity going forward? Which means if we see a big flood of money into IPOs once again, could that affect how the secondary market behaves? So I reached out to Pranav Haldea, Managing Director of Prime Database Group based in Delhi. And I began by asking him how he was seeing the overall flows and the absorption in the markets.
As you would already know, last year was a record year as far as mainboard IPO activity is concerned, and you had nearly 1.6 lakh crores being raised through mainboard IPOs. I will not even get into SME IPOs and other primary market activity, but on the mainboard IPOs alone, you had a significant amount of activity. And as far as the absorption was concerned, as I've been saying that in fact 2024 you saw an amazing confluence of supply and demand. So while you, of course, had these entire slew of companies looking to tap the IPO market, there was adequate demand as well. And not just from, domestic investors as is being reported mostly in the media, but even if you look at the foreign investors, while they sold heavily in the secondary market, they came in primary market in a big way. There was tremendous liquidity last year, and which is why you saw this kind of activity in the primary market. If you add QIPs to it, you had a lot of QIP fundraising as well last year. And just before this call, I was looking at this data over the last 4 years, which is from calendar year 21 to 24. And, I saw that 3.87 lakh crores has been raised from mainboard IPOs and another 2.5 lakh crores from QIPs. This is all primary market activity. In the same duration, the Sensex has gone up by 65%. So, a lot of times this dummy has been thrown about that, whenever you have a large IPO, it kind of sucks the liquidity out of the secondary market. But I think the last 2-3 years have really shown that, several large IPOs have hit the market. I think I heard the same thing when Zomato IPO had happened. After that, of course, you had several 10,000 crore plus IPOs which have hit the market. The liquidity has been there, the absorption has been there. And the secondary market has risen all alongside.
And when you talked about 387,000 and 250,000, you said 4 years, right? This is 4 financial years.
Yes.
So can you, for our listeners, distinguish between what is raised or sought to be raised through IPOs and QIPs? As in, people who use the QIP route, who are the people who use that route? Where do they raise from?
QIPs are basically used by already listed companies to raise fresh capital. Now, that capital which they are looking to raise, can be for expansion, for acquisition, for any kind of new businesses that they might want to get into. As the name suggests, which is qualified institutional placements, it is only targeted towards institutional investors. So you have FPIs, mutual fund, insurance companies, but only institutional investors who subscribe to these QIPs. Does it answer your question?
Yeah. You talked about FII selling, and we've, of course, seen consistent selling since September 27th last year and on to 2025 calendar as well. Would you have any sense of numbers in terms of if that shift or some of that shift has, or that money has gone into IPOs in India? What could those numbers be like?
So just as an example, in calendar year 2024, FPIs sold equities worth 1.21 lakh crores in the secondary market, while the invested 1.20 lakh crores in the primary market. The same figure for 2023 was a positive for both primary and secondary. So while they bought 43,000 in the primary market, they also bought 1.27 lakh crores in the secondary market.
Right. So you're saying that last year they almost technically, I mean, it may not be the same. I mean, money is obviously fungible, but they bought as much IPO stock as they sold in the secondary markets.
Not just IPOs, but all primary markets. So this also includes QIP and other primary market offerings.
If you were to look ahead now for, let's say, the next 3 months or so, or the rest of the current quarter and onwards, how are the markets looking on the same parameters? One is the ability of foreign portfolio investors to buy, including in the IPO or QIP. And secondly, the issuance and the retail investor sentiment as well.
Few things have obviously changed over the last quarter. One is constant concern in terms of the corporate earnings over the last 2 quarters. The second is what's been happening in the US. Of course, Trump coming in, yields rising. There's been a flight of capital as far as FPI money is concerned. But I still fundamentally do believe that there is demand for good quality paper at good valuations. If you do see some issuances in the primary market, you just had the mega issue of Hexaware recently as well. While retail and HNI did not participate in a big way, but you had significant QIB demand, which helped the IPO go through. Over the next couple of quarters, these concerns still remain. We don't have any trigger per se right now, which we can look forward to. But I think pickup in earnings would help improve the sentiment. Foreign investors have been exiting from the secondary market and entering via the primary market. Domestic institutional investors, just by the sheer flows which they have, 25, 30,000 crores worth of SIP money coming on a month-on-month basis, have actually become, the primary players in the primary market as well. From the past, when FPIs used to decide the price, now it's the DIIs who decide the price. And actually, they've been able to get a better bargain. And FPIs are following the DII behavior, and then they're investing into the primary market. So I think both as far as the secondary market is concerned and the primary market is concerned, DII participation has increased manifold. This is something which I expect to be here to stay.
So if you look at the valuation outlook, what you're saying seems to suggest that the valuation outlook for IPOs is better than what it is for secondary markets right now. But then there are also some other angles or aspects. For example, many investors, maybe not these investors, institutional investors, invest for the listing day pop. So how do you see that playing out in the next few months for those IPOs that will come?
A lot of institutional investors also play for the listing day pop, as the SEBI study showed. As far as individual investors are concerned, I think the number was that 3 out of 4 investors actually exit within a month of listing. So look, as far as IPOs are concerned, I think it's very important to know, what your strategy really is. Are you coming in only for the listing gain, or are you coming in for the long haul? Mostly, obviously, investors are coming in for the listing gain. And typically in a bullish secondary market, you do find that most of the IPOs give a positive return on listing. Very few investors come in for the long haul, because that requires a lot of hard work in terms of studying the offer document, understanding the company, understanding the sector, the promoters, directors, what kind of corporate governance practices are being followed, and then coming in. So again, to answer your question, if you are coming in for the listing pop, if there is a bullish sentiment in the market, the chances are quite high that you will gain on listing. Of course, there's a gray market premium also, which a lot of investors like to track, which gives a sense of whether there would be a listing pop or not. So what you've seen is that there is significant amount of exit in the first couple of months, but they do have a slightly longer term perspective than other investors.
Right. Thank you so much for joining me. Where will gold prices go now? So gold prices have once again risen to an all-time high, hovering above the $2,950 per ounce level on Thursday, thanks of course to continued concerns over President Donald Trump's tariff threats. Spot gold is at about $2,951 per ounce as of Thursday, after hitting $2,954 earlier on Thursday itself. This is the 10th record high this year, according to Reuters. So gold prices, traditionally a safe haven asset in times of wars and I guess in times of world leaders who cannot make up their minds, has gained about 12% this year. All eyes are now on the $3,000 mark, which is something brokerages had projected last year itself, but more for later in 2025. On Wednesday, President Trump said he would announce tariffs related to lumber, that's wood, cars, semiconductors, and pharmaceuticals over the next month. He's already imposed a 10% tariff on Chinese imports and 25% on steel and aluminum. Meanwhile, there are concerns over rising inflation in the United States, reinforcing the Federal Reserve's stance to hold off on further rate cuts. I reached out to Kunal Shah, Vice President and Head of Commodities Research at Nirmal Bank Commodities, and I began by asking him how gold prices were looking globally and then on India.
Gold prices have run ahead of its expectation. We were expecting gold to test $3,000 somewhere in the second half of this year. But just in 1 month and 20 days, we are seeing this price. So unbelievable rally in gold. A lot of reason attributed to it. And we feel that this rally has more steam left right now rather than just expecting, a nominal return. Gold in a current environment where we are seeing unprecedented debt levels of US, where if you look at the US balance sheet and you overall US debt and the amount of debt which is going to mature this year, $9 trillion is the debt which is going to mature this year. Already US 10-year bond yields are at 4.5%. And you look what is happening is you have no idea how they are going to service this debt and how they are going to repay this debt. So this is a big problem going forward. And the implication this has on the US dollar is extremely negative going forward. So irrespective of what Mr. Trump is doing right now, the inflationary expectations are surging in US. So on one side, what US actually needs is an easy monetary policy or a money printing in order to service their debt. And on the other side, the inflationary expectations are moving up. So how they are going to service their debt and how they are going to bring those yields down and pump more money in order to repay those debt and service those debt. So it's a very, very, whatever noise, what we are hearing from Mr. Trump, it seems like more of a diversion than the actual problem. And gold right now seems to be in the safe place and it is going to do well going forward. The entire economic power is shifting from west to the east and west is not able to tolerate that. And that's the reason why gold is behaving the way it is right now.
Right. And how are you seeing the outlook? Okay, let me ask you another question. So, what are the various factors that are driving up? One is traditional demand, including, let's say, from countries like India and China, but the newer demand, which could be central banks, that's one. So, what is driving it? And secondly, how are you seeing domestic outlook in India?
There are various factors, like you rightly said. The most important factor which is driving gold demand is the central bank. Okay, central banks have been buying 1,000 tons of gold from last 3 years, but that's not the number. 1,000 ton is not important. The reason why central banks are buying gold is at the core right now, and that is basically driving the gold prices. The central banks are buying gold because there's no alternative available right now for them. What are the alternatives central banks have in order to protect from the massive currency devaluation which may take place in US? What are the alternatives central banks has in a scenario where the Russian assets were freeze 3 years back by US? So there is no way the central banks are not going to buy the dollar bonds or they are not going to go back to the dollar. So here, the only thing which is left for them is gold. They are not going to buy anything but gold. And that's the narrative which is being played. Second reason, inflationary expectation. There are two possibilities. Trump really sticking to what he has said and comes up with the aggressive tariff plan and he puts the reciprocal tariff. In that scenario, gold is going to go up further because the inflationary expectation will move up. US inflation will surge from 3% to 5%. And another scenario is, in spite of whatever is being happening, US comes up with massive monetary easing in order to service their debt, in order to repay their debt. In that scenario, the dollar will collapse. So there are two roads going forward, as per me. So we are entering into a very dangerous phase. And that is driving gold demand. Because of tariffs, the parity of gold is being completely distorted. Gold is quoted at a $40 premium in New York as compared to London. So the entire equation, traditional equations have changed. The London vaults are getting empty. All the gold is going back to US and physically going back to US. And so entire equation of gold, the physical market of gold, the equation is changing. And that is very bullish going forward in a longer run. So already it has run up by 8 to 10% in the start of the year. There can be a small bout of profit-taking correction, which will keep coming whenever you see a news like Russia ceasefire happening There will be profit-taking correction, but still, it is going to provide refuge to central banks. It is going to provide refuge to investors. And I remain constantly very bullish about the overall outlook. And for next 2 to 3 years, I don't see any reason why it should crash.
Right. What about domestic prices? How are they looking to you in the near future?
So the domestic prices have corrected on account of the domestic demand has gone down by 15 to 20% on account of higher prices. In India, it is hovering at 86,500 as of now when we are talking. So there can be a small profit taking which can take prices to around 84, 83,000. But I see again gold is going to do well. What is going to happen with the Indian rupee? That remains key concern. So if the rupee is going to appreciate further or depreciate further, that is going to be the key thing to watch out for. And if the dollar is crashing, then rupee should ideally strengthen. So the gains on the domestic bourses shall be restricted by the weakness in the US dollar and the strength you can see in next 3 to 6 months in the Indian rupee. And that shall take gold prices in India to somewhere between 88,000 to 90,000 rupees on the MCX. So we remain very positive for next 2 to 3 years for gold.
Kunal, thank you so much for joining me.
Thank you. Thank you, sir.
Meanwhile, the action in the gold market or the intensity of it, something Kunal just referred to, is causing other problems in unexpected places, according to a fascinating report in Bloomberg. And this is as much a story of global trade as it is about interesting logistics. So keep listening. In London, teams have apparently been working hard to dig gold bars out or retrieve them from the Bank of England's vast underground vaults in the heart of the city. The reason? The bars have to be delivered to traders because while trades can be initiated on computers, bullion bars have to be physically moved in such large volumes that it has now exposed severe logistical bottlenecks in the global gold market, according to Bloomberg. So the bank's vault keepers are apparently busier than they've ever been in years. And while, on the other hand, logistics companies are obviously strained and refineries are packed with orders to recast gold bars from London into a form that can be delivered into the US futures market. Gold bars are flying around. More than 20 million troy ounces, worth about $60 billion, have entered the depositories of New York's COMEX exchange since the day of the US presidential election. That's November last year, with much of it originating from the London gold market, which is also the world's largest. The Bank of England holds about 420,000 gold bars, and January saw the biggest outflow since 2012. Remember, India too has had gold stocked in these vaults and has been slowly bringing them back into India. Staff apparently dug out about 8,145 bars, averaging 370 per working day, but then there is a backlog. So all of this is taken in armored trucks operated by firms like the Brinks Company, which also, by the way, moves valuable cargo in India, from the bullion yard at the back of the bank to airports outside London. But, says Bloomberg, rather than flying directly to New York, they first diverted to refineries in Switzerland to be recast into smaller 1 kilogram ingots that can be delivered against futures contracts on the COMEX exchange in New York. More chaos ensues there because the new ingots have to be registered and stored before being dispatched again. Well, moral of the story, I guess, apart from gold, maybe look for stocks of companies who are transporting it. And given how things are going, we will be seeing good business there for some time. The rupee stabilizes. The Indian rupee led gains amongst major Asian currencies and settled at a one-week high on Thursday thanks to dollar sales from foreign banks and softness in the US dollar, according to Reuters. The rupee closed at 86 rupees 66 paise against the dollar, slightly up for the day, and it was, more importantly, the best performer amongst regional currencies that rose thanks to a gain or gains in the Chinese yuan and the Japanese yen. The yen, by the way, has hit its strongest level in more than 2 months as investors ramped up bets on further rate hikes from the Bank of Japan. So, a few weeks ago it appeared, or we were led to believe, that the Reserve Bank of India was letting go and the rupee would somewhat float away to a more natural level. The last week or so does not suggest that that's really happening, with the Reserve Bank of India seemingly intervening quite often. So what's really going on? I reached out to Amit Pabari, Forex expert, and I asked him how he was seeing the rupee and the management of it right now.
Other Asian currencies have got much more stronger as compared to rupee. So for example, USD CNH was trading at 7.37. It has moved from 7.37 to 7.26 kind of a level. USD JPY was trading close to 156, 157. And it has moved from 157 to close to 150. And as far as rupee is concerned, it has not appreciated that much compared to dollar index for other Asian currencies.
And these are the main Asian currencies. So, and what does that say about the dollar itself?
November to Jan was a time period when dollar was getting stronger in anticipation that Trump is going to put tariff, inflation is going to rise in the entire world, and emerging market countries will suffer because of their export getting down. Now, let's look a little bit subtle. I think, as you have discussed last time also at your channel, that if we see Trump, whatever he says in the election or whatever he says, he puts tariff by only 10 to 20% of that scale. So, for an example, 2017, when he said it is going to put tariff by 25%, he just put 5%. So, basically, that story gets, and if you understand Trump, he's a pro businessman. So, he doesn't want stronger dollar per se. That is why in 2017, dollar index was trading at 101 at that point of time, came down to 89 in 1 year. And in his entire 5 year tenure, dollar index never broken that 101 kind of a level. So it shows that, in a way, history have shown us that Trump does not like stronger dollar.
Interesting. Okay. So let me come to now what's happening here in India. So there was a feeling a few weeks ago that the Reserve Bank of India was likely to let the rupee go at least a little bit and float away. It appeared for some time that that was the case, but now it looks like we are back to some form of intervention and therefore the rupee seems to be holding. Would that be a correct assessment?
This reminds me of a famous Hindi film dialogue where they say, do not underestimate the power of a common man. I will say, do not underestimate the power of RBI. What I like about this entire momentum was that it kept the trader, the speculator, the importer, the exporter all thinking what is coming next. And that is a sign what you want from a top level person in any institute or any place. So if everyone knows what I'm going to do, it doesn't make sense. So your moves are known. So by moving, from 84 it went to 88, and from 88 it came down to 86 and a half. That has kept the market confused. Prior to this move, last 14 months prior to this move, last 14, 18 months, it was only one-sided that our currency is going to get devalued. From 82 and a half, it is going to get 83, 83 and a half, 84. Although RBI was keeping in the range, but overall it was getting weaker only. So every time everyone wants to buy USD INR pair or want to go long in dollar. By this move, now people are scared. They cannot have one trade. And that is exactly what you want in the market, to have two-sided momentum. So the trader will not only go long. It can have both the sides momentum.
Does that mean that the Reserve Bank of India is allowing the rupee to therefore float a little bit or to find a natural level or not?
It was trading from 83 to 84. It was in a range-bound momentum. From 84 to 85, it took 478 days for rupee to come 1 rupee level. And from 85 to 86 in 15 days, 86 to 87, another 15-20 days, and 87 to 88, 10 days. So basically, they are not controlling that much. But saying that they are coming the way they had come in between from 88 to 87. Dealers were saying probably they must have sold close to 10, $12 billion near 87.95. But because of that, it has come down to 86.50 or 86.80 kind of a level that point of time.
You just told me a little while ago that you're visiting a lot of exporters in southern India right now. So obviously they're all looking to understand how the rupee will behave because they're obviously trying to tie up contracts and things like that. So what are you telling them?
Between 2018 to 2021, what has happened? Volatility was there on both the sides. So probably being Trump era, you want to derive a value of dollar or rupee by doing some kind of fundamental analysis or technical analysis or quantitative analysis. In a normal scenario, that we give a weightage of 90% to all of this scenario and 10% on sentiments. But right now, the scenario is such that you have to give 60% weight to all of that and 40% weight on sentiments. And sentiments is primarily driven by what Trump will say tonight. So when you have such kind of a scenario, then the best way to solve the problem is to hedge your exposure well. Rather than predicting the value of rupee or dollar or euro or pound, it is better that you plan your hedges well. If you are planning your hedges well, then you'll be able to sustain your margins. Otherwise, it will be very difficult for an exporter or importer to manage his bottom line.
Right. Amit, thank you so much for joining me.
Pleasure is mine. Take care.
Some very boring stocks are resuming in the stock markets. French energy management or automation group Schneider Electric posted sharply higher net profits and revenue for 24 on continued strength in energy management, beating market views according to the Wall Street Journal. The reason is artificial intelligence. And you might say, once again, artificial intelligence trends continue to boost data center demand, the company said in a call with reporters. That's Schneider. So data center as a segment continues to report the strongest demand in sales growth, according to Schneider in that report in the Wall Street Journal. But Schneider is not alone. Other companies in similar lines of businesses like Switzerland's ABB and Siemens and the US-based Eaton have all been posting solid results in the last quarter thanks to data center demand, according to the Wall Street Journal. And Google stores coming here. After Apple stores now brace for Google stores in India. A Reuters report says Google is close to deciding on locations where it will open its first physical retail stores outside the United States. Google has only 5 physical stores, all in the United States, which sell products like Pixel phones, watches, and earbuds, while Apple has 500 plus stores worldwide. So now Google is in advanced stages of finalizing locations in and around the capital of Delhi and Mumbai. If it opens in AeroCity area in Delhi, which is a little unlikely though, and BKC in Mumbai, maybe a little more likely, then all of this will be next to Tesla showrooms. How that will help, I'm not sure, but I'm sure it's good to know. That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.